Hello friends. Today let us discuss certain more basic concepts under the income tax law. We have already seen certain concepts in part 1 and part 2. So let us begin with this part 3 to understand more concepts. Tax, duty, cess and surcharge. This is what we are going to recapitulate and revise. Tax is a payment made to government of a country without any return. Now tax is non-returnable. Refund can be given back. If at all tax paid is more than the tax payable, then assessee can claim the refund, but tax cannot be returned as such, right? Only if the tax paid is more than the tax payable, the refund arises. Otherwise, whatever tax is paid, it cannot be returned. Then duty. Duty is a levy on goods. It is levied on goods. Then tax is upon the person's income or person's wealth. It is levied upon a person, assessee. But duty is levied on the goods. It is for the goods. Then cess, C-E-S-S. It is tax levied for a specific purpose. Then surcharge. Surcharge is an additional tax burden to those whose income exceeds specified limit. Then income tax, it is a levy on income earned by a person or assessee, and levy is not a tax. It means the act of clearing or charging the tax. Duty. Duty is an on-border tax charged on goods, commodities or things that we can physically touch, either while coming into the country or while going out of the country. Generally, it is a percentage of value of the goods. So duty that is levied for the goods manufactured inside a country is called excise duty, right? So it is on goods and it is on goods manufactured in our own country. Then it will be called as excise duty. Then duty that is levied on the goods imported from foreign country into our country, that is called customs duty. So if at all goods are crossing the borders of our country, then we can say import duty is levied, right? Then duty versus tax. What is the difference? Duty is on the goods and we have to pay this duty or tax first and then take the goods. So before paying the duty, we cannot claim the goods. We can take the possession of the goods only if the duty is paid, only when the duty is already paid. Thereafter, we can take the possession of the goods. Then examples are excise duty and customs duty as we saw above. Then tax is a levy on other than goods. Tax is levied on other than goods. So tax is levied only on the income or wealth of a person or assessee. For example, Income Tax Act, income tax, sales tax, service tax, etc. So these are on income or wealth and it is not necessary to pay it prior to the particular event of calculating income tax. So advance tax is paid. It's not that advance tax cannot be paid or tax deducted at source. These are paid in advance, but it is not necessary to have such a prior payment unless the slab rate or the slab is more. So if at all our income passes or if at all our income is more than a particular slab amount, only then we become liable to pay the tax before, we can say, in advance. Then surcharge. This is an additional burden to the tax being already levied. Generally, surcharge is levied for certain period of time only. For instance, surcharge is being levied on super rich in India. At present, surcharge is levied at 10% if total income exceeds 50 lakhs and 15% if the total income exceeds 1 crore rupees. Then what is cess, C-E-S-S? This is a tax on the tax levied by the government for a specific purpose. Generally, cess is expected to be levied till the time the government gets enough money for that purpose. The education cess is 3% at present. It is meant to finance the education in the country. So it has a specific purpose. Now let us go ahead and understand the residential status. Now, residential status of any person has to be determined to ascertain which income is to be included in computing his total income, his or her total income. The residential status can be classified under the Income Tax Act 1961 as follows. So, residential status under Income Tax Act 1961, there are mainly three types. First is resident, then second is deemed resident, and third is non-resident. Now, under resident, we can say resident or ordinarily resident, then resident but not ordinarily resident, and non-resident is altogether a different category, that is non-resident. The person is not resident in a particular country. So, in case of an individual, the duration for which he is present in India in the relevant previous year or relevant previous year and the earlier previous years determines his residential status. So, based on the days spent by him in India, he may be a resident and ordinarily resident, or resident but not ordinarily resident, or totally non-resident. So, there can be three categories depending upon how many days a person or assessee has spent in India. The residential status of a person determines the taxability of the income. For example, income earned and received outside India will not be taxable in the hands of non-resident. So, if a non-resident earns income outside India, so that income is not taxable. But it will be taxable in case of a resident and ordinarily resident assessee. There is also a concept of deemed resident for which presence of individual in India is not required. A deemed resident is always resident but not ordinarily resident. Then there are heads of income under which the income of any assessee is calculated or totaled. First head is salaries, then income from house property, then profits and gains of business or profession, then capital gains, then income from other sources. Now, after having total income, gross total income, there are certain deductions from this gross total income in case of an assessee opting out of the default tax regime. Now, there can be two types: deduction under chapter 6A and deduction under section 10AA. So, under chapter 6A, there are certain subtypes: deduction in respect of certain payments, that is, examples may be life insurance premium, contribution towards provident fund or pension fund, medical insurance premium paid, payment of interest on loan taken for higher education, payment of interest on loan taken for residential house, payment of interest on loan taken for purchase of electric vehicle, or rent paid, or donation to certain funds, charitable institutions, and contributions to political parties. All these examples can be categorized under the deductions in respect of certain payments under chapter 6A. Then next type is deductions in respect of certain incomes. The examples over here may be employment of new employee, then royalty income, etc. of authors of certain books other than textbooks, then royalty on patents. So, all these can be included under deductions in respect of certain incomes under chapter 6A. Then deduction in respect of other income. Examples may be interest on deposits in savings account, interest on deposits in case of senior citizens. These are deductions in respect of other income under chapter 6A. Then other deductions are deduction in case of a person with disability. Again, this is under chapter 6A. Then computation of total income. Determining, there are certain steps. So let us read this flow chart or flow diagram or arrow diagram for that matter, we can say. Computation of total income is done as per this particular arrow diagram or chart. Determining the residential status in the first case, then classifying the income under 5 heads that we have already seen: salaries, income from house property, profits and gains from business or profession, capital gains, income from other sources, etc. Then all the income under all these heads is clubbed or totaled to find the gross total income. Compute the income under each head applying the charging and deeming provisions and providing for permissible deductions and exemptions thereunder. So while calculating or totaling the income under all these three heads, what are we going to take care of? We will consider the charging of income tax under charging of the income tax under the Income Tax Act under various heads, then deeming provisions, whether the income is deemed to be taxable or not, then providing certain permissible deductions under the Act and exemptions thereunder. After considering that, we can apply the clubbing provisions, that is adding of the income of spouse or minor child. Then after that, we have to set off or carry forward the set off of losses as per the provisions of the Act or default tax regime. Then at this stage, we are with the gross total income. We have already computed the gross total income at this stage, and from that we get certain deductions. And after deducting deductions from gross total income, we get total income payable, income tax payable. Then application of the rates of tax. Now, application of the rates of tax on total income can be explained as follows. Rates prescribed under section 115 BAC of the Income Tax Act or for default tax regime. Now, under this section, it is provided that for concessional rates of tax to individuals, HUF, AOPs and BOIs, that is individuals, Hindu undivided family, association of persons and body of individuals, and artificial judicial persons as well. Now, under this default tax regime, certain exemptions or deductions are there. However, not available like leave travel concession, interest on housing loan on self-occupied property, deductions under Chapter 6A, other than Section 80CCD2 and 80CCH2 or Section 80JJAA, etc. The rates given under Section 115 BAC are the default tax rates unless the assessee exercises an option to shift out of the said regime. The basic exemption limit under this particular section is rupees 3 lakhs. This means that no tax is payable by an assessee with total income up to rupees 3 lakhs. So it reads further as follows. Up to rupees 3 lakhs, nil rate of tax, no tax. From 3 lakhs to 7 lakhs, 5% is the rate of tax. From 7 lakhs to 10 lakhs, 10% is the rate of tax. From 10 lakhs to 12 lakhs, 15% is the rate of tax. From 12 lakhs to 15 lakhs, it is 20% on the net income. And above 15 lakhs, the rate is 30%. Now let us see. The new tax regime is the default tax regime for financial year 2025-2026. As per the provisions of Section 115 BAC of the Act, it offers lower tax rates with limited deductions and a basic exemption limit of rupees 4 lakhs. The slabs are as follows. Up to rupees 4 lakhs, nil, that is no tax. 4 lakhs to 8 lakhs, it is 5%. 8 lakhs to 12 lakhs, it is 10%. 12 lakhs to 16 lakhs, it is 15%. 16 lakhs to 20 lakhs, it is 20%. And 20 lakhs to 24 lakhs, 25%. And above 24 lakhs, 30% is the tax. Now, what are the key features of this new tax regime? Here the standard deduction of rupees 75,000 for salaried employees is there. Then income up to 12 lakhs is effectively tax free due to tax rebate under Section 87A. Then deductions like house rent allowance or Section 80C, 80D deductions are disallowed under new tax regime. These are not available for the assessee. Now, the old tax regime offers multiple tax savings, deductions and exemptions, but a higher tax rate. According to assessment year 2026-27, these are the slab rates. Up to rupees, and the old tax regime offers multiple tax saving deductions and exemptions, but at a higher rate. Taxpayers can opt for the old tax regime if it is more beneficial to them. So, up to 2.5 lakhs, nil, no rate, no tax. 2.5 lakhs to 5 lakhs, it is 5%. 5 lakhs to 10 lakhs, it is 20%, and above 10 lakhs, it is 30%. Now, this is how the old tax regime was working. The old tax regime offers higher basic exemption of rupees 3 lakhs for senior citizens and rupees 5 lakhs for super senior citizens. Then under standard deduction is 50,000 for salaried individuals. Old tax regime offers various tax savings and deductions and exemptions. Income up to rupees 5 lakhs is tax free due to section 87A rebate. So these are the rates prescribed by the Annual Finance Act under optional tax regime. Then surcharge rebate under section 87A. Surcharge is nothing but an additional tax payable over and above the income tax. Now income tax is calculated, and over and above that it is additional tax burden called as surcharge. It is levied as a percentage of income tax where the total income exceeds rupees 50 lakhs. So below 50 lakhs, if the income is below 50 lakhs, there is no surcharge. If at all the total income exceeds rupees 50 lakhs limit, then surcharge is payable. The rates of surcharge applies or applicable for different slabs of total income are to be seen forward after this. Then rebate under section 87A. In order to provide tax relief to the individual taxpayers, 87A section provides rebate from tax payable by an assessee being an individual resident whose total income does not exceed rupees 7 lakhs, and under the default tax regime under section 115 BAC, or rupees 5 lakhs under normal provisions of the Act if he opts out of this default tax regime. So this is how the difference is. Now health and education cess on income tax. The income tax has increased by the surcharge or reduced by the rebate under section 87A. It is to be further increased by additional surcharge called health and education cess on income tax at 4% of income tax plus surcharge if applicable. Then what is alternate minimum tax? The Income Tax Act contains certain profit-linked and investment-linked deductions under the normal provisions of the Act to promote investment in various sectors. The tax benefit help to reduce the tax liability of the taxpayers who exercise the option to opt out of the default tax regime under section 115 BAC and become eligible to claim such deductions. Now this is upon the individual assessee whether to opt the old scheme, whether to opt for the new scheme, or whether to have alternate minimum tax, etc. Individuals, HUF, AOPs or BOIs and artificial judicial persons paying tax under tax regime under section 115 BAC are not liable to alternate minimum tax under section 115 JC. Then advance tax and tax payable. Although the tax liability, advance tax and tax collected at source. Although the tax liability of an assessee is determined only at the end of the year, tax is required to be paid in advance in 4 installments on the basis of the estimated income. That is on or before 15th June, 15th September, 15th December and 15th March. However, residents declaring profits under presumptive tax scheme where business or professional income is computed as a percentage of gross receipts or turnover can pay advance tax in one installment on or before 15th March. Then tax payable or tax refundable. After adjusting the advance tax and tax deducted or collected at source, the assessee arrives at the amount of net tax payable or refundable, whichever is the case. Such amount should be rounded off to the nearest multiple of rupees 10 as per section 288B. The assessee has to pay the amount of tax payable called self-assessment tax and before due date of filing the return. This self-assessment tax has to be paid before due date of filing the return in his or her case. Similarly, if refund is due, that will also be there after filing the return of income. We can get the refund only after filing the income return. So this is what we have learned right now, that income tax is levied on assessee's total income and such total income has to be computed as per the provisions contained in the Income Tax Act 1961, and there are few steps to calculate such tax payable. Firstly, we are required to determine the residential status of the assessee. Thereafter, we have to classify the income under different heads, whether it is salary, business profession, house property, or other sources, etc., or capital gains. Then exclusion of the income is done which are not taxable to chargeable to tax. Certain income which is not chargeable to tax has to be excluded or it is exempted. Then computation of income under each head is to be taken. Then after that, clubbing of income of spouse or minor child is done. Then setting off or carry forward of or setting off of losses, etc. is done. Then we have to compute the gross total income in this way. From the gross total income, deductions from it are allowed, and thereafter we reach or we arrive at the total income. Application of the rates of tax on the total income is done thereafter, and surcharge if relevant, surcharge if applicable is added over here. Then education and higher education cess and health cess is then added up to it, and then lastly we arrive at the figure of advance tax or tax deducted at source. So this is how we calculate total income and compute the tax payable for any assessee. So thank you for being with me. Let us understand certain other concepts in the next video. Thank you.